Okay, well, a very warm welcome to you all, and I'm not sure if I'm supposed to say this afternoon because time zones might change, but we really appreciate you being here. You know, back in '95, when we were the Agricultural Markets Division of what was then SAFEX, the South African Futures Exchange, we pioneered agricultural derivatives in South Africa. Back in 2009, we also pioneered, we believe, the use of cash-settled commodity derivatives, cash-settling them off the Chicago Mercantile Exchange. And today, in a sense, we're pioneering again because as far as we can make out, this is the first time that we've actually used this type of marketing or information session by way of a webinar. And what we want to do and what we hope for is really just the smooth transition of information about trading oil on the JSE. And we hope, as I said, it's going to be informative and very beneficial for you. So let me welcome you, those of you sitting here in the auditorium in Sandton, and also those that are gathered in front of their TVs. I trust you're picking this up loud and clear, and that for you too it will be a very interesting experience. I also want to make special mention and welcome to Dan Brewster from NYMEX in New York, who's joining us, is live on the line, and will be presenting up-to-date information on the situation at NYMEX and the crude oil, the West Texas Intermediate oil contract that they trade there. And then our own Chris Sturgis will deal with how that links into us, and Doe Stain from Nedbank Capital will also then talk to us about the mechanism and the role of market makers in that procedure. So if I can go to the agenda or the program for this afternoon, a very brief introduction from myself, and then we go straight to New York to Dan Brewster for his presentation. His presentation will not be, it will be live in a sense, audio live, and we have his presentation and he will talk through his slides live. And then on to the JSE and the crude oil, the specifications of the contract that we trade by Chris Sturgis. And then understanding the role of the market maker, Nedbank Capital, Doe Stain. We will have, following each session, questions and answers. Now that's very simple. For those of you in the auditorium, we will have a roving mic. Those of you who are linked up, please, you can type in your question. We will gather those questions up, and those questions will be relayed to the relevant persons for an answer. So if you have questions, and I believe you can, any time during the session, you can type your question in, and it will be picked up here in the auditorium. So if we can then just go to a little bit of introduction. It was way back, now it seems a long time ago, when we first looked and had exploratory discussions with what was then the CBOT, and later became, as you know, the Chicago, the CME group, with regard to listing foreign reference contracts and trading them in Rand in South Africa. And Chris will go through that. In fact, I think it goes back probably to a time when I had a dinner and I sat next to Bob Ray of the CBOT at that stage, and we got on very well with each other, and we basically came to the conclusion we should get closer together. That was in Bucharest in Romania, and I'm delighted that guys like Chris and my team took it on to the stage where we are today. It was in 2008 that the Reserve Bank gave us approval to trade under certain conditions foreign reference commodities, and the first one we introduced, being the agricultural division that we were, was obviously the CBOT corn contract. So we trade, as I think most of you know, a domestic maize contract, and then we also trade the CBOT corn. And what, of course, is very interesting is the spread between those contracts. But that's discussion for another day. What the licensing agreement basically does is to allow us to close or expire the contract on the very liquid market and the price coming off of Chicago. As you know, the CME group, having joined up with the CBOT and NYMEX and COMEX, now the biggest derivative market in the world. And what do we do at the moment? We currently trade the CBOT corn contract and the soybean complex, that being the meal, the beans, and the oil. Also, for those of you who are not quite in that space, a very interesting, what we call a complex of products. And in fact, next week we'll be having a webinar on those products as well. And then we trade the crude oil, which is really the subject for today, platinum, and the COMEX gold. So without any further ado, Chris, if I could hand over then to Dan. Dan, I hope you're picking us up loud and clear, and thank you very much once again for being part of this webinar.
Okay, thank you, Rob. And we're excited to be partnering up with the JSE and also to offer our WTI crude oil benchmark for trading. And I hope you can hear me okay. And what I'll do is why don't I begin with our discussion today of the WTI crude oil market. What I have on my first slide are some of the key characteristics that make for a good oil price benchmark, and I think one of the key characteristics in the oil market is that the transactions in our market are fungible and standardized, which means that it allows for a good unit of currency in the oil market that everybody can rely upon. The other key characteristic is a very straightforward and direct convergence with the physical oil market, which is what we achieve in the WTI crude oil market. The other key thing in any benchmark is transparency. And in the case of the WTI market, there is a real-time and a very robust information and statistics around the marketplace that make it very clear. In addition, there's the market does have to respond to fundamentals, and that's also key in the oil markets. I think the other item that everybody's always looking for is liquidity, and certainly that's critical for anybody who would like to use our futures market. Okay, what I'd like to do is go to the next slide. If we look at the characteristics of the WTI market, we have a market where we have unambiguous and clear fungibility in our market with the transactions. And the market is standardized around a 1,000 barrel contract size. And we have a very clear and dependable convergence mechanism. And our crude oil contract is also physically delivered at expiration, which links it directly to the crude oil market. And I think the key thing that we also have to remember is that the information and the statistics around the WTI market are very transparent, and they come out on a weekly basis, which makes for a very robust market with information that's freely flowing. I think the other key thing in our marketplace is that the oil market does respond to real fundamentals, which is the physical supply and demand of oil, which continues to be, very active and the main driver in the market. The other thing I should point out is the WTI crude oil market is the most liquid physical commodity in the world. So that's another key thing that WTI has to offer. Okay, what I'd like to do is just to go on to the next slide and just talk about WTI and the link to the world oil market. And I hope everyone's able to hear me okay. The key thing that makes oil such a liquid commodity and such an active market is the fact that it is very much a global marketplace, and the key global benchmarks are linked to each other very closely. In essence, the world oil market is a network of regional markets that interface with each other, and that's where we get the liquidity and the arbitrage between the different locations. And this principle of arbitrage is very important because it allows the key benchmark like WTI to also be closely linked to Brent and other waterborne or imported crudes that are coming into the U.S. marketplace. And if we look at the in the mid-continent North America, which is where the WTI crude oil market is based, we find that there's upwards of 1 million barrels of waterborne imported crude that's coming in. At the same time, there's pipeline barrels coming in from the domestic U.S. market as well as from Canada. So it's a very robust market that includes both imported crudes as well as domestic crudes, and they all kind of come together in a very strong, tightly linked arbitrage market. And I should also point out that the CME has also commissioned a study that looks at this linkage between the global benchmarks. And it's a very interesting study put out by Pervin and Gertz, which is available publicly both on our website and at the website below for Pervin and Gertz at that link. On the next slide, if you look at the global oil marketplace, you find that there's a number of key benchmarks that all kind of are linked and priced very closely together in an arbitrage that kind of brings the whole global marketplace together. And at the top of that list, you have the WTI light sweet crude oil futures contract, which is the key benchmark for the U.S. and our market here, as well as linking directly to the Brent crude oil market, which is the main benchmark in Europe. And there's also a key link into the Middle East and into the Asian markets with a strong pricing arbitrage with the Dubai and Oman crude oil benchmarks. And then turning to the next slide, just as more of an informational piece, I've put together kind of the pipeline map in North America just to show the general flows of crude oil that are in the WTI market. And the WTI terminal, or the main hub for trading, sits in the middle of the U.S. at our Cushing hub, which has pipeline access to Houston and the Gulf Coast of the U.S., which brings in a lot of imported crude, and there's also pipeline connections coming in from Canada, bringing in imported Canadian crude, as well as a lot of U.S. domestic crudes, which all come together at the Cushing hub, which adds to the liquidity and the vibrancy of the WTI market. And turning to the next page, it's really important again to stress the real-time and reliable statistics that make for a viable benchmark. And in the case of WTI, we have an abundant amount of information that's available about the oil markets. We have the crude oil inventories data, which comes out on a weekly basis by the U.S. Department of Energy, and those statistics are closely watched by everybody in the marketplace. At the same time, you have statistics that come from the OECD with their days supply statistics, which are put out by the IEA, the International Energy Agency. And the U.S. statistics actually are probably the best in the world and the most up to date. The U.S. EIA data are weekly, based on they come out every Wednesday, based on a Friday afternoon survey assessment, and that information is available to the entire marketplace, and it makes for a very transparent market where everyone has access to virtually the same information. So it's a very level playing field, and it makes for a very fair marketplace. In the next slide, I present a chart just that shows the liquidity in the WTI market, which is the upper line there. And this shows our daily trading volume in a number of contracts traded, each contract being equivalent to 1,000 barrels. So in the case of WTI, which is the upper line there, roughly 700,000 to 800,000 contracts per day are traded, which is equivalent to 700 or 800 million barrels of oil that are changing hands every day. And the liquidity in the WTI market is generally twice that of the Brent market. And there is a very tight, arbitrage linkage between these two markets. So the liquidity in each of these markets is very deep, and the NYMEX WTI is really just the largest and growing liquidity, and it continues to grow, which makes for a very excellent benchmark to base your cash settled contract on. And the next slide, I just generally show the WTI volume again, and the red line there shows how electronic volume has continued to grow and is now close to around 95% of our volume is transacted electronically on our Globex system, which is our 24-hour traded system, which allows for liquidity basically around the clock, 24 hours a day. And that's an important point, because in a global marketplace, you need to have that liquidity available around the clock. In my next slide, in conclusion, then, with looking at the WTI market, liquidity is is king, and especially in a cash-settled type of market, you know, a robust liquidity is very important, and transparency is probably next for people to have good information on a market that they can trade, and in both a real-time basis have reliable information about the marketplace. And in the case of WTI, it responds to the market fundamentals, so information about supply and demand will drive the market, and it still makes for a very reliable and interesting market to trade. And the key thing in the oil market is that you have that link to the real physical market, so that you know that your oil price is linked to the fundamentals and linked to the real market, which is definitely the case with WTI. And finally, there's a strong link across all the global benchmarks that keep the market very liquid and very much a robust and volatile market. And I think that concludes my my presentation. And I think we have some time for some question and answers, which if anybody has any questions, we'd be happy to take them.
Indeed, Dan, thank you very much. Let me say, first of all, thank you, and you came through loud and clear, so we appreciate that. I did omit to tell you, Dan, that in our audience here in the auditorium at the JSE, we have a wide variety of people, in a sense, from top economists in South Africa through to lowly brokers, or maybe it's the other way around. So I'm hoping we are going to get some questions from them, and then also from our computer base. And then I did also admit for you guys in front of me to say that Dan is really the energy man and the oil man of NYMEX. So we're very pleased, Dan. Thank you very much for agreeing to be part of this. So are there any questions, first of all, here in the auditorium? And we do have a microphone. We ask that you please use that so that your voice can be picked up for Dan. Dan, let me start in the absence of no question, but I think that a lot of people might want to ask this question. I think it was in your first or second slide where you talked about the close correlation, obviously, of the physical market and the futures market, and then the burning question of the $150 a barrel market that we saw, and how was that really related, or was it related to the physical value of oil?
Yeah, I think if you do look back at what was happening, you know, economically back in 2008, when we had that move up to $150 a barrel, the economy was very much overheated, and I think commodity prices reflected that across the board, and definitely that $150 oil was a real price where people were buying and selling. And in our market, you know, after expiration, you have a physical delivery obligation. So wherever that barrel of oil traded, that represents a physical delivery obligation. So we look upon that as a real price, because both buyers and sellers have to honor that.
Okay, so some guys bought some very expensive oil.
Yes, that's true.
Yeah,
although at the time it probably looked cheap.
Yeah, indeed. Yeah, we do have a question from the audience. Eleni?
Hi, Dan. Eleni Jocka from CNBC Africa. Most of the investors, analysts out there that I chat to keep saying that we see a lot of speculators in the market. I mean, obviously that alludes to Rod's question as well. You know, you keep talking about the market responding to fundamentals, but many would argue that we see more speculators in the oil market as opposed to fundamental drivers. What's your response to that? And also just, excuse my ignorance, but it's quite interesting when you talk about the inventory data that is released on a weekly basis. How is that measured? Because from what I'm understanding, aerial shots are taken. So you could just clarify for me. Thank you.
Okay. I think that one of the good things about our marketplace is we are regulated by the U.S. government, which means that on a weekly basis we have to report the positions that speculators hold in our marketplace, and that is also reported by the government now on a weekly basis, and we do watch that, and I think all of the marketplace watches the level of speculative interest in the crude oil market. And generally speaking, even in the period when we did run up to $150, we still had, even though we had some strong participation by speculators, the market was still dominated by commercial oil companies who were in the market hedging their price risk. And I think generally we see the percentage of speculators stay in kind of the area of 30, anywhere from 20 to 40% of our marketplace, while the big commercial companies represent probably 60 to 70% of the activity on our marketplace. So, I mean, we look upon speculators as being an important addition to our market because liquidity is always very important to have, and the speculators provide a lot of liquidity. But at the same time, our market is, continues to be dominated by commercial participants, which makes for a very healthy market and keeps it, in line with, the real demand and supply in the market. The other good thing about the U.S. market is that the weekly statistics, which are put out by the U.S. Department of Energy, they are mandated reporting by the oil companies, and they have to electronically report to the government what their actual inventories and production statistics are. So companies are very careful to report the correct numbers, and the U.S. statistics are probably the most accurate in the world, just because they are, mandated as far as reporting goes. So it helps to add to kind of the robustness and the usefulness of the WTI market. It helps to know that you have the best statistics almost in a real-time basis that are updated weekly. So we think it's a big driver in the market, to have that good information.
Okay, thanks, Dan. Any more pressing questions from the floor? Any coming through? Okay, then, thank you very much, Dan. I really appreciate that, and we have your email address up on the screen, as you know. I'm going to hand over now to Chris Sturgis to get into the meat of the contract that we trade in South Africa. And I'm not going to say too much about Chris, except that he was, once in his life, he was trading or selling carpets door to door, and I'm very pleased that we managed to get him away from that. And he's become not only my right-hand man, but right next to me, and in many cases leading, as he's done in developing these contracts. So thanks very much, Chris.
Thank you, Rod. I was worried that story was going to come out there. So yeah, from a fairly pleasant and transparent corporate salesman, I hope to convince you that, and just enlighten you of the contract specs that we've done. You've listened to Dan, liquidity, and liquidity is king. And we're very, very fortunate to be able to tap into that market. And how do we do it is really trying to mirror those contract specs out of New York and to bring it back to the South African investor. And Just to go through the contract specs fairly briefly, they're on the web. You can certainly study them at length there. So the underlying product that we're trading is light sweet crude oil, in essence the most liquid contract, crude oil contract in the world. So whatever happens on that side will ultimately come through on the South African side. Doe we'll chat about a bit later, but remember the product is traded in rand, so it is going to be the rand price of WTI crude oil. We have the trading code WTIO, so you'll see in a lot of the presentation and Doe as well, we reference to it's just the JSE trading system code, which requires 4 characters. So if you see that anywhere along the line, that means it's the JSE crude oil contract and not the actual underlying NYMEX. Getting to the expiry month, and when we designed the contract working with the market makers, we wanted to tap into the most liquid months. Now, anyone who understands the oil markets, there's a trading month every single month. You can take physical delivery every single month, but what we wanted to do as a start is really give exposure for 4 key months, and that's where we tapped in. We looked at where the large open interest is on NYMEX, and really your June and December keeps on rolling out, and we've also introduced then a February and a June contract. I'll get down to, there's a bit of an anomaly because ultimately in the US the contract goes through to physical delivery. Even though we're trading a June contract, for example, it doesn't mean the contract trades all the way through up until June in South Africa. So just bear with me and watch out for that. The contract size, you heard Dan talk of 1,000 barrels. What we wanted to try and do is make it more accessible for the retail investor, and so we brought the contract size down to 100 barrels. Okay, something similar to that that we've got on the stage. 100 barrels, coming back to us in liters, is just under 16,000 liters is one contract. Phoning up my trucking friends, they told me that one of the large trucks takes 600 liters in a tank, so basically you can hedge 26 tanks of diesel in your truck if you're interested with one contract. Quoted in South African rands, naturally under special orders from our Reserve Bank. The minimum tick size is just 20 cents, and then ultimately at expiration, if you still have a position on the JSE contract, you will be cash settled, and I'll work through that process very soon. Expiry date. What we had to do, and this was also part of the approval process from Reserve Bank, is to make sure we give the market makers enough time to unwind their position so that they don't get physical delivery. Okay, Reserve Bank certainly didn't want any of the market makers reporting to them saying, we now own 1 million barrels of oil in Cushing. So you'll notice that the contract is structured to unwind, to actually stop trading 1 day earlier compared to theirs, and that's just to allow the market makers, for some unknown reason, if they couldn't unwind any of their positions, they had extra time to do so. You can see we're very optimistic that our open interest would be significant over time. Trading hours, and certainly that is the issue at the moment. We trade between 9 and 15:45 South African time, and that largely just was because the products were only available to commodity derivative members. They've also been expanded to the equity derivative members, so we've introduced these products to both derivative memberships on the JSE. So if you're a client trading single stock futures, you can easily access this through your existing account with your SAFEX broker. So currently, we stopped trading at 3:45 with the 15-minute admin period. Our plan and vision is to expand the product range within this global market by introducing international derivatives, and when that happens, we'll certainly extend the trading hours for these commodities, then giving you a longer overlap of trading in the New York market. Initial margin requirements, similar to any of the other derivative products, currently on oil, they are adjusted on a monthly basis. So 6,500 Rand initial margin for a 100-barrel contract. And if you so wish, wanted to trade this calendar spreads, go long 1 month, short the other, you also then recognized with a reduced amount of risk, and we then only require 1,900 Rand per contract for the initial margin. Daily mark-to-market happens in the last 5 minutes of trading every single day. Basically, we revalue the position and just make sure we can mark to market each and every position. Exchange fees, currently 10 Rand per contract. That is the JSE fee. Your broker will obviously have a component, plus the clearing member will also be charging a fee. On the South African contract, we do not have any position limits at this point in time for speculators. Obviously, there's position limits in the U.S. market, as Dan was referring to, and it all depends on the growth of this contract. If it was a significant player, we might need to bring in position limits, but they will be typically from guidance from the U.S. regulators. So at the moment, certainly you can go wild as far as positions go. Now, who can go wild? I think who's the qualifying audience. If you look at this, this is similar to the currency derivatives. We have the IDX products. Individuals, foreigners, and corporate entities have unlimited access. They're certainly not exposed to any of the foreign exchange limits. As far as pension funds and long-term insurance companies go, they're subject to their 20% foreign allocation limits. And then asset managers and collective investment schemes have a 30% of their foreign allocation limits. So, yeah, still some restrictions around that. But, again, the big play was on the individuals, the foreigners, and the corporates. And then on the trade types accommodated, following in line with the traditional grain products, we've always been in favor of full transparency, therefore full order book transactions. So if you're interested in trading, you have to go through the central order book. You have to show your price. And that's why at the moment we have 4 market makers. We're very fortunate to have 4 banks quoting live prices throughout the trading session. And if you wanted to trade, you've got those players quoting a price on screen. We do appreciate that we have a shorter trading period. And if you wanted to do a business in the core U.S. trading times, you could then transact that with the market maker and report that to us the next morning. So we do allow that flexibility should that be required. There is a minimum on that at the moment of 200 contracts. Just to work through the settlement process, we introduced these products on the global market on the 1st of July, and we have since then seen some financial members start participating. I think as underlying grain guys, commodity guys, you're always used to products going into physical delivery, so you know about first notice day, first delivery day, and terms like that. But just to also understand the settlement process with crude oil, and Dan showed the charts of exactly how physical delivery and where it takes place. We will start, the typical example being December contract. It stops trading on the 18th of November. So already, if you're accustomed to financial instruments, if something says December, you're expecting it to expire either the 1st of December or a Thursday in December month. With the crude oil markets, we're now mirroring what's happening in the U.S. The U.S. contract actually expires on the 19th, but we expire one day earlier to give market makers enough time to unwind positions. And the rest of the time of the contract in the U.S. is actually used to book schedules for physical delivery. Remember, as Dan said, what keeps the contract honest is that it has to go to physical delivery. So someone did pay $150 per barrel and took delivery of that expensive oil. On the South African side, no physical delivery whatsoever. So again, just put your mind at ease. We stopped trading on the 18th. What happens? We stopped trading 15:45. There is a settlement process that will take place to determine the final cash settlement value. Comes through on the 19th because of the overlap, and when we take that final cash settlement value, we're not always ready for our mark-to-market on the day. So what we do is the final cash settlement value is only published to the market the next business day when there's no trading, and you'll get your final profit and loss adjustment on the 19th. What we do the next business day, in this example, the 22nd, we'll give back most of your initial margin. Everything except for 1 Rand, and that's really just for our system to keep on going through so that we can say we're trading a December contract. So a bit of admin processes, and this is only applicable if you have a position on last trading day. Typically, you expect most people to roll their positions and try and wind out of that before you get to expiration, which we've seen in most of the previous contracts that have traded. So just again to go back, there's a very strict rule that it's the 4th business day following the 25th day prior to the expiry date. Very long terminology. Don't stress about it. All those dates are on our webpage. Go to the crude oil products page, and you can simply see exactly when the contract's going to expire. For all those brokers who offer DMA, obviously you want to just program something on your side that your clients are notified and have them rolling those positions before the necessary expiry date. So yeah, fairly simple. 18 stops trading. We give you back most your profit and loss is adjusted on the next business day. On the 22nd, in this example, you get most of your initial margin back, and on the 1st of December, everything else is closed. Now, to make sure, there's always concern of market abuse, and how do you get to that final cash settlement price? Can the market makers, the banks in South Africa, influence that cash settlement price to make profits? On an extremely slim chance of that ever happening, what we've done is we reference on the daily, every day the contract's trading, we use our methodology to determine the mark-to-market, but at final cash settlement, we will take trading activity out of NYMEX. Out of the U.S. market, we take 15 iterations. It all depends if we're on summer or winter time, but typically on summer, South African summer, between just before 5, we'll take 15 iterations, and we'll take 30 iterations on the rand-dollar spot rate. And in this example, if we got to $78.15 per barrel, that was the average over 50 minutes. The average over 30 minutes on the currency was 7.54 rand. 589.25 rand is your final cash settlement value. So it all depends on where you traded. You'll either have a profit or loss. Important thing is you're accessing NYMEX liquidity. You're accessing NYMEX liquidity in one of their most liquid trading sessions. So it's not in an overnight trading session. It's going to be around 10 o'clock New York time when there's a significant amount, and it's only 15 minutes. With other products like gold and platinum, we take it over 30 iterations, but we appreciate that WTI is extremely liquid, and therefore we've taken the 15 iterations. The risk for the market maker is they need to then go and try and mirror that mark-to-market process, making it obviously their challenge, and that you'll see it flow through in some of the pricing that comes through. On the JSE webpage, we have if you go and look through the products, you'll see the crude oil contract. Go and look at that. It's got your trading calendar. It's got your initial margin requirements that will change monthly. And really, if there's any other questions, you're welcome to send them through to the commodities at JSE email address. Are there any questions on those basic specs? Sorry, this.
On those no trading days on the 22nd or the 19th, I assume you can obviously trade into the next contract period.
What will happen is up till quarter to 4 on the 18th, you can roll that position. But come the 19th, there is no more trading. So you cannot.
But you'll be trading in the
next month. Yeah, the February, the June. Quite right. So what we've done thus far is we've always had 2 expiries listed. As we get to one expiry, we just introduce the next. What certainly, if there's interest for additional expiries, something very easy to load on our side.
Chris, good afternoon. Can you just indicate if there will be options on these oil contracts as well?
Very good question, Marcus. Yeah, we're just finalizing the specifications with the markets and getting sign-off on clearing members. We could expect those options to be introduced in the next 2 weeks or so. What we've done there is 10 Rand strike intervals. These are SAFEX-style options, so American-style, similar to what we trade. You can exercise any time up to expiration. And what we're doing is on a volatility surface, a volatility skew. As a starting point, until we have enough trading activity on the local contract, we're going to take the volatility surface from the NYMEX market and then just publish that to the market once a month. So that will be the skew, the volatility skew that will roll out. But certainly as far as options go, plans in the next two weeks to get that on board. We're just testing the skew process. Thank you.
The question comes from Alf Becker. Where can we get the cost of carrying crude?
I'm going to look. Obviously, you want that directly from the NYMEX market. I will follow up with Dan. I don't think Dan's online any longer, but it's all that kind of information, those storage costs. As any exchange, we're standardizing a number of the storage components, and that forms part of the contract. And that typically would be on the web page. But since I know Alf Becker very well, I'll pass that on to him. Thank you.
Actually, Chris.
Oh, Dan.
This is Dan Brewster. I'm still on the line.
Beautiful. Dan, come and tell me I'm wrong.
Generally the carrying cost for crude oil is 50 cents per barrel per month. So that's a good number to use in your cost to carry.
Fantastic. There's another question coming through. Dan, hang on there.
The next question comes from Zintle Njali. Is there any reason why the SARB has no limits on trading for individuals or foreigners?
It's a very good question. I think there was a lot of work, and we have to give credit to the currency guys who introduced currency derivatives, the Yildex team. It was perhaps just clarified how the contract works to SARB, and really at the end of the day, there's a lot of reporting that goes through to the Reserve Bank, and also a better understanding that there's really no cash flow leaving the country with this product. You have an authorized market maker who's doing the hedge offshore, and for everyone else participating, your rands are still staying in South Africa. It's not that we're moving foreign currency offshore. And with the Reserve Bank, knowing that we provide them daily reporting of everyone's transactions, everyone's positions, and the fact that there was actually, unless you're a foreigner or a market maker who has approval, there was no physical rands or currency leaving the country. That gave them the comfort to extend that to the corporates. In 2000, must have been about 2 years ago. Yeah. Any more questions?
Okay, thank you. I think I'm coming in. Thank you very much, Chris, for that. And now, in a sense, to complete the loop, it's very important. Chris mentioned on a number of occasions the role of the market makers, and the market makers were necessary in the plan of things because of the Reserve Bank. And as Chris said, the whole idea of this is to allow South Africans exposure to this contract in rand. And to talk about market making, I'm very pleased that Dov Steyn from Nedbank is here. Dov Steyn, head of commodities at Nedbank. But I must also acknowledge the other market makers in our market, being Rand Merchant Bank, being ABSA, and being Standard, who also play a very important role in making sure that this contract is available on our market. So thanks very much, Dov.
Thank you very much, Rod. I think we'll chat around the pricing a bit, and then we'll give some of the other market makers maybe a chance to maybe just also get in a comment if there's anything from their perspective. So the aim here really is to discuss how we price and give everybody a bit of comfort around this. I don't think we're trying to blow anybody away with the sophisticated pricing models, etc. I think your discerned economists among you there are going to find slim pickings here, but I think at the end of the day, when you pull the trigger and you want to trade, have comfort in the price, have faith in the price, that it's correct and that there's nothing behind it that isn't explained properly to you. So let's move on here to the first slide. As we've now seen, building blocks on pricing WTIO futures, two markets involved. We're using NYMEX, that's the originator of liquidity, and we use the dollar-rand outright market. Now, questions been leveled earlier to me, why don't we use the Yildex currency futures as a starting point to price? Okay, so what we've decided, market makers, we will go to the originator of liquidity. We'll go to the dollar-rand interbank market, and we will source our pricing from there. I think it will give everybody comfort, makes product a bit cheaper as well. So pricing on dollar-rand, we need some outright pricing here. And in this case, dollar-rand forward market works on a swap basis. The swap market, we're going to have a quick look at the pricing just now. we need to extract an outright price for these futures closeouts, for the futures dates, for the specific contracts out of that market, and we'll go through the calculation. But the most important thing here to say is that your NYMEX price is an outright price already. So there's no conversion that needs to take place from a NYMEX perspective, but there is a conversion that needs to take place on the dollar-rand side. Also important to note that when we are making a market to you guys, it is live. Everything happens live. We've got live links to the exchanges, and we've got live links to the interbank currency market as well. And we'll talk around the risks of having live pricing just now. So here we've got the pricing curve on dollar-rand. We've got 3 blocks, and bear with us if you know these markets well. We want to get to the lesser sophisticated investors as well, and just explain to them how we get to those levels. So we've got 3 blocks here. On the left, you've got your forward market and your forward points. Mid, we transform those forward margins into cents. And on the right is the outright prices on dollar-rand going forward from spot, 752 on bid, 754 on offer, all the way out to the 1 year sitting at 796 and 3/4 and 99 3/4. Basically what we're trying to say here is, on the left, if you look at your points in the 1 year, 44.75, 45.75, these points are traded, and what they basically, or how we get to them, is the interest rate differential. There's a specific calculation behind this. I don't think we need to go through that specific calculation, but suffice to say that these points are expressed as interest rate differential percentage of the currency, and they are actual cents. They are traded market, 44.75, 45.75 in the 1 year, going back down the curve. We transform those points that are traded into cents, and we add those cents up to current spot price of dollar-rand to arrive at the outright price. Moving on, we need to now calculate an outright price for the specific maturity date for our contract, which in this case is 18 November and 19 Jan. We look at the DEC WTIO and the Feb WTIO, 114 days, 176 days. We use our curve that we've just built and the amount of days corresponding to each period, and we extract linearly out of the amount of cents, amount of points, which we then transform into an outright price. And we end up with a price there on the right-hand bottom side there. 114 days, we sit with 765.94 and 768.44 as a double. And also for 176 days, which is the Feb maturity, 773.52 and 776.02. We then use those prices to convert, okay? And in this example here, we show the December and the Feb Crude Light contracts, bid and ask, 78.40, 78.43. We work out those outrights, we get our outright price, and we convert into a DEC and a Feb price of 600, 603, and 613, 615, which eventually are the prices that you'll see on screen when you want to trade with us. If we look at the role of the market maker and the associated risks, we're primarily there to provide you guys with liquidity. I think that, as you've now seen over the last couple of months, competition amongst market makers lowers the spread. Okay, there's reasons that the spread is wide to start off with. Think of it in terms of an old CBOT trading pit, people stepping up to trade slowly but surely. People filter into the trading floor and there's a bit of more action happening, and so competition amongst the market makers forces down that bid-ask spread, and it's come down. I think we've sat at 10 at some point. We're down sometimes 3, 4 on an average, nice and tight. Settlement mechanism ensures fair pricing. Chris, you've spoken about that. Really, for us as market makers, there's nowhere to hide. At the end of the day, when we mature, we are going to pull to this price. And indeed, every day at closing time, you're more than welcome to check those prices. What you see on the screen, the derived price that you see on the screen, that is where we mark to market, and it's taken via your building blocks, as we've just explained there, and there you mark to market. So there's really nowhere to hide for a market maker. Moving on to liquidity considerations, some of the associated risks, and we've spoken to some of the other market makers just before we came in here. Liquidity is one of the main risks on our side. I know that flow has been small, but as we grow, liquidity does become a little bit of a constraint. And I'm going to jump ahead here and quickly look at a NYMEX Crude order book. Just show you there, 79.02 bid, 79.04 offered. And the point I'm trying to make here is that you can see there's 13 on the bid and 1 on the offer. So as an end user of this market, I can only offlay so much volume into that market, and I need to adjust my price so that I can get out of a significant position at worse prices. So the order book basically tells you where you can get out. And I think when we talk about pricing, if you take into account the order book where we need to offlay or hedge our risk, there's a very easy example that you can see that it's not all volume done at just 2 prices. It's not bid ask 02, 04, and 100 by 100. Yes, volume picks up throughout the day, and we'll look at the volume pickup just now. But as a market maker, we need to be cognizant of what's available on NYMEX. Fast markets, slippage. You know, some of the we've seen this many times on our side. We get traded on the oils, and when we want to hedge, the market's already moved. So the market is volatile, and there is a bit of execution slippage, and these costs all transform into that bid ask. So that's where we need to recover some of the money that we lose along the way, a little bit here, a little bit there. We need to recover in the bid ask spread. Systemic challenges, we've seen that happen over the last couple of months. Most of what we try to do here is electronic. So in a perfect world, yes, absolutely. If everything's automated, no problems. But every now and then a little glitch comes in, or you lose your live links or whatever, and then there's a bit of a misprice. Amongst market makers, we feel very comfortable that we can get out of those specific transactions. So there's no problem there. But as I say, they do happen, and if they happen, we're back on screen in a couple of seconds again. Volatility considerations. If we can quickly jump ahead a couple of slides here. You know, volatility of oil, as you all know, it is volatile. You know, on the short end, on the option side, for Crude Light, implied vols 40 up to 60, 65, sometimes higher, depending on the market. It can be volatile, and it can be hairy if you need to get out of your position fairly quickly. So there's a certain amount of volatility consideration given as well. And then lastly, from our perspective, facilitating larger flow than what's available on screen. You can give your market maker a shout, and they will be able to quote you a price in larger flow that's available on screen. So if we quickly have a look at the volume bull that we spoke of earlier, you can see that during the day when we open on our side at 9 o'clock, there's relatively lower volatility than what you see in the afternoon. Afternoons are picking up quite drastically from about 3 o'clock onwards. So if you're a fairly big user of liquidity and you need to do something fairly stiff, then obviously that time segment will suit you much better. Not to say that liquidity is tight in the short end. We're facilitating some flow there. There's no problems on the liquidity side, but it definitely picks up a bit later during the day. And then I thought, you know, for the guys that's never traded any oil contract, or, you know, not the most sophisticated of the lot, I think it's important to say, understand your risk, know what you are trading. We're trading the rand price of oil here and not the dollar price of oil. Volatility implication, we've had a look at this slide of mine. The volatility on the rand side, the rand price of oil, pretty much follows and tracks. So there is a relationship. It's not a one-for-one relationship, but there's a fairly stiff relationship. So you are trading in something that can be volatile. Obviously, differentiate yourself from your traditional equity-based investments. You can go long and short future. It's a geared future. Understand your exposure and what type of risk you're taking on board here. If you take a look at the price comparison itself, again, very closely associated with each other. They move almost in tandem. There's little points in time where they don't move one-on-one. So know when you get involved in the investment in WTI that you shouldn't always look for a one-on-one move with the NYMEX price. It's rand price of oil. Okay, that concludes a brief discussion. Is there any questions surrounding the pricing specifically?
Yeah, locally? Anything abroad? Yes. Yes.
My name is Conor Ipenyo. I just want to find out where did you get the data for WTI 10 and WT10, WTIO, whatever.
Okay, if you're referring to pricing data, let me explain it like this. NYMEX is open most of the day. It's almost open 24/7, or not 24/7, but 24 hours a day. But the order book is well published in the market. So as a market participant, and almost everybody a market maker will have access to the depth of market, they call it, of the contract. So the slide that I showed you here, if I can just quickly step back. This is the order book here on the left. Okay? So that order book is completely visible to all market participants. This order book is changing on a second-to-second, inter-second basis as flow comes into the market. So it changes obviously as we progress throughout the day. 3 o'clock, that order book moves around quite a bit. So we source our specific input data in our pricing off this order book, and we'll source it through a vendor like a Reuters or a Bloomberg, etc., etc. We'll source it through. We've got some additional guys that we use, but I think most people use one of the larger data vendors in the market. So that.
Yeah, no, I do understand for NYMEX. Now, what about setting up GSE one?
Yeah. And help there, certainly from our web page point of view, we store all historical data since we started trading. There's not much, but if you're looking for a one-off, just to give you some historical information, you can send us an email and we can supply that to you. Just so you can do that chart, go, I think, one ahead, go. Sure. Because you probably want to do the comparison next between what South Africa's contract, which includes the rand dollar exchange rate versus just the dollar price. So we can supply that to you. We also, on the web page, supply 15-minute delayed information. But it's going to put a lot of pressure on you because you understand these market makers, their prices are changing as the currency, the forward points, all the underlying NYMEX market price changes, so they update their prices. So you know, if you want to just really start trading the product and get a good feel of historical data, we can certainly supply the charts. And as you get more interested in actively trading it, you can access it through a direct market application. So become a client of a member, and they can give you a terminal that can then allow you to actually trade the market.
We have done some calculations on the back of that, but suffice to say that you as an investor do need to do your own calculation on that basis. You need comfort around the fact that it isn't a one-for-one relationship, that it can move. Now, remember that when you do the calculation or the inference, it's historical, so it doesn't, you know, it might not hold for future movement. But as an investor taking a decision to participate in that market, you really need to do that analysis.
Okay, Rod, a question, yeah.
Question from the webcast, Zintle Njali. How effective is crude oil hedging as a risk management strategy?
Well, I guess my answer to that would be is how good a hedge you take. I mean, it's pretty much what is hedging is really price insurance. And you must decide whether you would like to take out insurance on your prices or not take out price insurance. And obviously, I think it's pretty much like if you want to insure your motor car and you don't have any accidents or your car is not stolen, you've got to ask yourself, was that insurance worthwhile? But it's always, the hedge is always for a movement adversely, and if you see the volatility in oil, then obviously you know that the oil price can move against you, and it's your choice whether you want to hedge that or not.
I think I can also add there that that the hedge is only as effective as the homework that you've done surrounding what you want to hedge. So you need to quantify as a hedger, you need to quantify for yourself what are you looking to hedge and quantify into which currency you want to hedge. As soon as you know what you are looking to hedge, then you can design a hedge. So for me, it's really in the hedge specification almost where the risk lies.
Okay, well, yes. Sorry, just hold on.
Will this help us when we want to hedge the byproducts of crude oil, like fuel oil and all that stuff?
Look, I mean, NYMEX Crude is one of the most liquid markets out there. It is the leading benchmark for pricing energy. If you get into the lower classes, the diesels, petrols, jet fuels, etc., the relationship isn't a one-for-one relationship. So there is a certain amount of basis risk involved, and you need to be aware of that basis risk. Riet from RMB, do you want to just add to that?
The hedging effectiveness is in using just your Brent or WTI in terms of the South African diesel prices, usually between 56 and 65%. What you are not hedging is your crack spreads. And obviously, if you just go for the US price, you're not hedging your dollar rand, your rand exposure. So in terms of this, the big issue for diesel or petrol or fuel or jet fuel is that you're not hedging the crack spread.
Okay, well then, I think all that remains for me is to say thank you to a number of people. Firstly, to Dan, if you're still there, Dan, I really appreciate your input into this. And have a good day.
Thank you, Rod.
And then to Chris, my colleague, and to Doe, thank you very much for giving an all-round information session. I want to thank our marketing guys for putting this together, and especially the tech guys. Thank you very much. It was something we were, as I say, pioneering out into something we weren't quite sure of, and I'm pretty sure now that we'll use this again. I always thought these barrels were some type of physical delivery, and now I know they're not physical delivery, but thank you to Trevor for the statement they make, and we really appreciate having the barrels around. Thank you to you guys for coming to the JSE this afternoon. We really appreciate that, and thank you to everyone who logged on and took part in the webinar. So thank you very much, and you are dismissed. And those of you at home, you can shut your computers down or you can surf the internet for something else.